Hello, Misfit Nation. This is Dave Lukas, and welcome to another episode of the Misfit Entrepreneur, where it is our job to help you unleash your inner misfit and break through to higher levels of success, wealth, and fulfillment by bringing you the best insight and information from the world's top entrepreneurs, with a specific focus on their misfit side, the specific traits, habits, and secrets that have allowed them to thrive and succeed. As a reminder, if you're new to this channel, hit the subscriber button below and give this video a like and comment as well. We do our best to respond to all comments as fast as we can and we see them. This week's Misfit Entrepreneur is Mark Willis. Mark is a man on a mission to help people think differently about money. He's the founder of Lake Growth Financial Services, a 3-time #1 best-selling author, and he's host of the Not Your Average Financial podcast. After graduating with 6 figures in student loan debt, how many people can relate to that? And discovering a way to turn his debt into real wealth as he watched many people lose their retirement savings and home equity in 2008, Mark set out to help his clients take back control of their financial future and build their business with proven tax-efficient financial solutions that mostly are unknown to the financial gurus out there. As a result, he's become known as Not Your Average Financial Planner, and he's helped hundreds of clients and entrepreneurs radically change their wealth path for the better. So I'm excited to have him come on, share his methods and ways to maximize your income and become debt-free. So Mark, are you ready to unleash your inner misfit?
I'm ready. Let's do this.
Hey, it's a pleasure to have you on. And this is a great topic because there is, I've studied wealth building for a long time, right? I have a financial education business and everything, but I'm still amazed at how many different vehicles and ways of doing things are out there to maximize wealth, tax benefits, everything. And so I'm excited to get into this stuff with you. But before we do, I alluded to a little bit in the beginning, but you've got kind of an interesting story going from, being in a huge debt to getting out of that debt and then figuring out how to effectively become financially free. So tell us your story. Take 5 minutes or so and just tell us, how'd you get to where you're at?
Well, you're right. I didn't know much about money. There was not a lot of education in the public school I went to in K through 12, and I went to a private university, and they held me back for grad school. So that's even more money out the door, and I didn't have it to give. I remember one of my first memories in college was going to the nearby hotel as I was getting all my stuff all settled into the dorm rooms and signing away my life on those promissory notes, with Sally Mae and all of her cronies. Going deeper into debt, and little did I even really understand what was going on. Fast forward a little bit, we've now been able to wipe clean all that debt, but not just get out of the debt, be actually better than debt-free, which is some strategies we've used and even trademarked for our clients who really run the gamut. Not everyone we work with has my story, certainly not. A lot of our clients are working as business owners, real estate investors, even some NFL Super Bowl champions. Mm-hmm. But most people, Dave, that I work with are just looking for more control, certainty, capacity, and potential realized in their life. And that's what we love doing all day long in working and serving our clients.
So let's start to dig into that. You're known as a sort of contrarian financial expert, if I would say. So let's start just like high level. What is your philosophy on investing in wealth building?
Well, the general notion, the non-contrarian approach would be, buy as early and as often as you can, buy stocks, bonds, mutual funds, index funds, ETFs, and then you get the hope and pray strategy where some investment planner says, hey, over the last 100 years, the stock market has on average produced 8% returns, let's say. And hey, you know what? Let's reduce that down to 6%. Are you comfortable with that? Okay, great. Let's say it's 6% a year on average for the next 40 years. You're 20 years old. Let's fund your 401k. Let's set it aside for the next 40 years, and you'll have $1 million in your retirement account at retirement. And couldn't you live off $1 million? Okay, great. Sign here.
Sounds so easy.
That's the typical financial plan. Say again?
Said sounds so easy.
Yeah, sounds easy. Almost, a monkey could do it. Well, so as it has happened, we now have the evidence. The 401k has been around since 1981. All right. So that's actually interesting for a lot of people to realize that it's so young that the 401k is not even old enough to retire yet. And yet we have this grand experiment with $20 trillion baked into these things called IRAs and 401ks and other government-sponsored retirement accounts. Since the passing of ERISA in 1974, we all really became a nation of speculators. So it's like Dr. Phil said, all the time, he says, how's that working out for you? How are we doing as a nation of speculators? Well, the average 401k balance, if you're over 55, is under $100,000. And if you're over 55, it's just under $100,000. And if you're younger than 55, the median balance of a 401k is just under $45,000. So we don't have enough money to turn that into an income that would last the rest of our lives. $100,000 in a 401k, I mean, I hate to say it, but that's about maybe $200 a month in retirement that you could safely pull out of that thing. So it's hard to say that we've really been successful as a nation of investors. So that's my first problem. We don't really have the skills to really become a nation of investors/speculators. There are other problems too with the traditional approach, including fees. The Department of Labor says that the fees on your IRA or 401k, if they're just 1% a year, doesn't sound like a lot, Dave, right? But a 1% fee, this is according to the DOL, over 35 years will actually suck out over a third of your life savings.
Yep.
A third of your life savings just on that fee.
It's that compound effect.
So the only guy, that's right. Yeah, it's a domino effect. And as your account balance grows, that's just more and more money for the investment planner. So the only one with a guarantee is the investment planner, who gets a regular stream of money off your back. And I guess the government gets a guarantee too, since it's a taxable IRA or 401k. Right. The only one without a guarantee is the schmuck who's putting the money in that thing. You and me, right? The 401k investor, the IRA investor. Then there's market volatility. I mentioned earlier that the average return of the market was 8%, but I want to do a little fun mathematic experiment with you for a minute, Dave. You ready for this? Let's say you have $10,000, and let's say you invest that money into some sort of investment and it does just bananas good. Like it's doubled in the first year. You get 100% rate of return. Your $10,000 went up to $20,000 in year one. So far, so good?
Yep.
We're liking things so far. So you stick with that investment, and unfortunately, in the second year, you lose half of your money. So your 20 grand goes back down to the original 10,000 you put in there. Ouch. At least you didn't lose money, right? Sort of. We didn't talk about time value of money or inflation, but at least you're back down to the 10,000. Right. Yeah. Right. So the question is, what was your rate of return? Most people would say 0, right? But did you know that the average rate of return, doing that math, and what the SEC allows the investment guy who sold that investment to you, he's allowed to say that he gave you an average rate of return of 25%. How is that possible? That's easy. 100% return in year one, negative 50 in year two, divide by 2, and that's an average of 25. So did you feel any wealthier? I didn't feel wealthier. I mean, that's no more money. Exactly. Yeah. So these are the problems that most people don't realize, that we have this statement we get from our 401k or our real estate portfolio or whatever it is, and we think average rates of return are somehow meaningful. They're not. They're meaningless. And yet we hang our hopes and dreams on this average rate of return, which is some of the reason why we call our show Not Your Average Financial Podcast. So this is the typical way of doing retirement planning. And, I just think there's got to be more efficient, better ways to do it. And thankfully, we've stumbled across some strategies that have helped others.
Well, I want to unpack some of those, but you've kind of hit a nerve with me, because one of the things that I'm really passionate about is wealth building and people taking control of their financial future versus ceding it to others. Not that there aren't some great financial advisors out there. Obviously, you're a CFP. But I think as you talk about the traditional ways, the 401ks, in fact, if you've got a really, really great CPA, a lot of the CPAs that work with a high net worth individuals will tell you 401k is one of the worst investments you can do. There's something to be said for a match if you're in a corporation to get that money from a match standpoint. But as you kind of illustrated, you can have a good run and then a 2008 hits, or even a 2022 hits, where you have a drawdown of 30% or so, and that knocks out years of gains. And what people don't realize is you have to make up not just the 30% to get back there. If you lose 30% in a portfolio, you got to make almost 100% to get back to where you were again, And so it's a timing thing that, you have to watch out for too. But here's my thing. And this is something I've been on a soapbox about. I go and I talk to high net worth individuals about and really teach about this, because it's amazing. The government puts it right in our face, and people, it's right there for everybody to see, but nobody goes and sees it. A lot of people don't know that the government publishes a financial health report every year, like a Fortune 500 does a end of year summary, their financial statement report they do. The government does it. Comes out this year, came out in February, and they glaringly tell you that we are absolutely broke. And we're not physically responsible. They don't even have checks and balances. In fact, I think the term was material weaknesses in being able to keep track of where money's going. Social Security alone is negative 75 trillion in debt. And we're sitting on 33 trillion in debt and growing fast. Now, here's the thing that we throw around these words nowadays, like trillion and this type of stuff. And the universe has been around for what is thought to be about 13 billion years, the Earth about 4.5 billion years. And we're sitting on 33 trillion in debt, and the CBO is usually wrong in its projections. And right now, and they're not wrong in a good way, they're projecting that the US is going to be 50 trillion in debt by 2030. That's basically 6 years away. And right now, like, the universe is like a pimple on the what of $33 trillion. And so it's unfathomable. And so part of me is like, it's over, at this point. Like, it doesn't mean we go away. Rome didn't go away. Elements of it still exist, but it's not the same way. And it's certainly not the prosperous nation that it was. So what do you think is going to happen to the markets, inflation? And I realize this is a huge question, the economy over the next 5 or 10 years. And then based on what you said earlier, what can entrepreneurs start doing now to prepare themselves and set themselves up for financial success? Because there's certainly going to be turmoil with all this.
I don't know what's going to happen in the future. And any financial planner who says otherwise, you should run, not walk away from that person, because no one has a crystal ball. Mine actually is in the back here and the batteries aren't working. So I'm not sure how to fix that thing. But here's what I do know. The day after the end of the world, there's still going to be a need for commerce. We're going to be hopefully sitting on some capital, and we're certainly going to be sitting on some land. And so there's going to be an economy of some kind. The question is, how are we going to interact with that economy, and who's going to be the ones to take full advantage of those resources? Capital and labor are really going to still be around the day after, the economic collapse, whenever that day comes, whether it's in our lifetime or beyond. But there's still going to be airplanes. There's still going to be buildings. There's still going to be people wanting to do work. And that's where the entrepreneur can really come in.
And it's a natural evolution. Like it happens throughout history. I mentioned Rome, but the Dutch were one time the reserve currency and top, economy in the world. And it's ceded to the British and so on. So the countries are all still around. It's just they aren't at the peak that they were, right? So, and that does mean things change. Quality of life changes, different things, happen. And so that I think that's what I'm getting at. I'm not even saying end of the world. I'm just saying I think we're going to go through a change where maybe what you're used to is not what the lifestyle and things are like as it is today. I think when you're settled with that much debt, it's inevitable that you're going to have those challenges.
Absolutely. Well, there's this idea called Parkinson's Law, where a luxury once enjoyed becomes a necessity. And we have surrounded ourselves with luxuries. And believe me, I like my luxuries. My heated seats in the middle of winter in my car, that's a necessity here in Chicagoland. But at the same time, it's important to realize that, you can find yourself in the worst of situations, and there will always be someone. Let's say that we just flattened the economy and no one had anything of worth or value.
Didn't we just do that
I
like
would
in
wager.
2020?
Yeah, maybe. But I would wager that, and you can probably look at the statistics here, that there's going to be those that take advantage of that opportunity. And before 30 years are over, the vast majority of the wealth are going to be in the hands of the very few who took advantage of that situation. There's always going to be people, when you lose your golf ball in the woods, there's going to be some kid in there who's going to find it and sell it back to you. That's just the way of the world, right?
Yeah.
So it's always good to think long range in reverse. And you've done a great job even in this episode talking about that. What in history mimics the present? So I believe in something called the Lindy effect, which you're probably familiar with. But for your listeners, it's essentially a simple process, and it's really a philosophy that says, all right, the longer something's been around, the more likely it's going to live a longer time. So, for example, this is why I believe that, and I'm making another prediction here, that the book is going to outlast the Kindle. Why do I believe that's the case? I believe that's the case because the book has been around before the Kindle, and it's going to be around after the Kindle. It's why I think the Bible is going to outsell this week's New York Times bestseller in the long run. And this is because of the Lindy effect. The chair will outlast the iPhone for the same reasons. So it's good to think through, what are things we can do with our money and there will always be money. I don't know what currency it's going to be in all the time, but money has predated caveman times, really. You go back, there's a great book called Debt, the First 5,000 Years by David Graeber. I don't agree with everything he says in the book, but I like the title especially. So 5,000 years is a long time. And I would suppose that there's going to always be a need for debt and money and currency, whatever we might call it. So looking to the past, what were things that have existed for eons that we can readily account for or predict will continue to exist even past this week's meme stock or even past this week's cryptocurrency? So what are some of those things? And I'll just say one for sake of example. Insurance contracts. They've been around since the Roman Empire. There's a TikTok trend going around. How often do guys think about the Roman Empire? I'm guessing this episode's going to show up in that in that trend. But in the Roman Empire, there were insurance contracts. In fact, I went to a museum, didn't know I was going to go see this thing, but I was just I'm a nerd, so I like biblical archaeology. I like seeing Mesopotamian stuff. I go to the Egyptian side of the museum, and there it is. There's a 324 BC insurance contract. Someone was getting a guaranteed lifetime income insurance pension in Egypt, from 300 BC. So this is interesting to me as a financial planner who likes to think counterintuitively. What are insurance contracts doing in the Roman Empire? What are they doing for folks today? What can I do with an insurance contract, of all things, as an entrepreneur to ready myself for whatever the world might throw at us in the next year, 5 years, 30 years, 150 years? So interestingly, contracts are the basis of civilization. So we're getting down to first principles here today, Dave, and I'll hush after this, but contracts, if we don't have the contract, I'm sorry, we're done with civilization. At that point, there's no, because I can live in my house and without the contract, all I have is squatter's rights in this house. Without a contract that says I own it or I'm paying on the mortgage, I have to have a contract that says that's my house over there. Otherwise, it's just who's got the bigger shotgun.
Sure.
And the same is true with all our other contracts too. Now that's in contrast to the 401k or the IRA or your bank account. There's no contract there. You're just paper wealth going up and down, up and down. What you want is a contract with your money where you own the number in that contract. So I want to be able to say, hey, when I'm 60, when I'm 50, when I'm 80 years old, that's my number. It's a contract baked in and even guaranteed, which is a very hard word to use as a financial professional. But if I can find that, then I know I've got at least something that I can build a future toward no matter what happens.
Yeah, and that's a great example. I mean, other examples that people hear about are obviously gold, land, things like that. And I guess to further this, in talking about, okay, great. So, things looking back, looking at things that last the test of time and last through good times, bad times, and everything in between. You're a big proponent of the bank on yourself principles. And I think a lot of people have maybe heard the term before, but they're not sure necessarily what it means. And maybe they've heard some things that aren't true about it, that sort of thing. So explain what bank on yourself is and how it works.
Yeah, I'd say of all things, and believe me, as a CFP, this was not where I was intending to take my career. I was working happily with a tax return preparer, and I was helping her with some of her accounts. But I was overhearing those calls she was making. This was 2008 and 9 and that sort of thing. She was making those dreaded calls to her clients saying, "I'm sorry, Mr. Client, I just lost you half your life savings in the 401k nightmare that was 2008. So I didn't want anything to do with that, and I almost got out of the industry. And then I stumbled across this concept called bank on yourself. And for me, it was a salve. It was like a eye-opening experience, but it was also something I felt like other people should at least know is out there. So I'll quickly explain it. It's a modernized variation on a hundreds-year-old financial asset that has grown every single year, regardless of what the stock market's doing. And regardless of what the bond market or real estate market is doing, it grows every single year for several hundred years at this time. It's dividend-paying whole life insurance, of all things. And right there, for me, when I heard that, I almost shut down. I almost had my mind shut off, and I almost didn't follow through with looking into this. I thought my buddy, it was a professor of mine, college professor, told me about this, and I thought he was in some sort of cult or scam or something. But I studied it a little bit, and it started to really become compelling. So I'll kind of break this down. I got a little acronym, TGIF. I'll keep this real simple for everybody. When these policies are designed properly, and that's really the most important sentence in this whole thing, if it's designed properly, because it can really be messed up. But if it's designed right, it does four things. There's some amazing tax advantages. And if we designed it properly, we can even get the money out completely tax-free. That's the first piece to this puzzle. Also, it's liquid, accessible money, both in the future and right now. So unlike your IRA or your SEP IRA or your real estate deal, you have access to the money in that policy in the first month, in the first weeks. As the years go on, you can be 29 or 55 or 85 years old, and it's liquid money, and you can use it for whatever you need, whether your business or maybe you need to fix up the kitchen at the house or send the kid to college. It's liquid available cash. So that's the first thing. It's done with some tax advantages and could even be done tax-free, liquid and available right away. Number two, the money in the policy, not the death benefit only, although that's there too, but also this thing called cash value. The cash value grows guaranteed. So it grows on a predictable basis, again, outside of the markets. I like to say you don't want to just have your eggs in 12 different baskets. Those baskets might be on the same truck and it could go off a cliff. We need some of our money in another truck. And this is a non-correlated asset called life insurance. So it grows on a guaranteed basis inside a contract that's yours that you can use for any reason. Third, this is life insurance. So I stands for insurance, and you'll clearly leave your family more than you've saved for them inside the policy. So if I have, let's say I pass away tonight and I have $1,000 to put it somewhere. If I put $1,000 in my savings account, my family gets $1,000. If I put $1,000 into my policy and I die tonight, my family would get a lot more than $1,000 income tax free due to it being life insurance.
Right.
Then the final thing is financing. My guess is a lot of the business owners on this listening to this podcast are needing financing more than they think they need insurance. And I would probably agree with you. Like our need for financing stuff, cars, inventory, real estate, whatever your needs are usually far greater than your need for insurance. So what if you could become your own source of financing? What if you could essentially be your own source of financing or be your own banker and borrow against your own line of credit you have with yourself and actually pay for those major expenses, kids' college, inventory, your tax bill, and just like a bank, let that money continue to grow and compound. without interruption, even on the amount you borrowed out. Now, that's how it works with these policies. Let's say I've got $200,000 of cash value. Okay, so $200,000 of cash value, and I borrow out 180 grand to go buy a real estate deal. My policy will continue to grow and compound on the full 200,000 bucks, even though I've borrowed out the 180. And of course, my 180 is now doing its work in that real estate deal as well. So now I have the complete control to repay that loan to the policy that I control, that I own, and I can set up a repayment plan or not. If I never pay off the loan, they just deduct it from my death benefit when I pass away. So that's the long and short of it.
Yeah, there's a point to that that I want to bring up, and you did a great job of really explaining what bank on yourself is and kind of the philosophy behind it, the TGIF, and then obviously the example of if you got 200,000 borrowing 180. I think this is where for people, and I think this is important to understand, because I think there's been a good marketing job against these type of policies and against this type of way of building wealth. Which is funny because a lot of the very, very wealthy employ this strategy, right? And so it's almost like, don't look at what I do, that type of thing, right? But You mentioned 200,000 borrow 180. Now, I think the important thing is that 200,000 is earning a return, right? So, and typically, I don't know right now, what's a typical going return? 4 or 5% a year? Is that what we're at?
Yeah. Part of that TGIF, the G stands for guarantees. Yeah. And so that guaranteed increase of the cash value plus dividends, now dividends aren't guaranteed, but They've paid a dividend every year for over 100 years. So that's pretty sure. But yeah, we're looking in the middle single digits. 4, 5, 6% is pretty typical.
So if somebody borrows 180 to, buy a boat or, purchase a house, an investment or whatever they're going to do, that doesn't come out with zero interest though. They do have to pay an interest rate on that. And that's typically going to be higher than what they're getting in the policy. Is that right?
Correct. Yeah. So in this case, you would be borrowing from the life insurance company that you're a co-owner with. So let me use this example and then I'll come back to some specific numbers. All right. So let's say you and I decide to open a mortgage company together. All right. So you and I own this mortgage company, you and me. We're getting other people to buy in and get our mortgages going. Let's say I need a mortgage. Am I going to go to any other bank or am I going to come to our company?
Right. You're going to go to your company.
What do you think? Yeah. And obviously I want to use our company. It's my company, our company together. Now, Dave, are you going to want me to pay back the mortgage that I borrowed from our company?
Of course.
Yeah. Why is that? You're a business owner, right? You want to get this thing paid back. Are you going to charge me a little interest on that?
Of course.
I hope you will. Yeah. Otherwise, we're going out of business.
Yeah.
Yeah. Now, who benefits when I pay back that loan to the company that you and I own together? Who benefits from the interest I pay?
The company and you and I. And that's what I was really trying to get to is, let's say that you borrow that money out and it's at a rate of 7%. Right. But I think right now, the 30-year mortgage is sitting around 7.5%, 7.8%. Right. So you can just use that. If you went out and got a mortgage, you're paying 7.5% on that. But in a model like this, you're really only paying about 3%. Or a little bit less because you're getting that 4 or 5%, that's growing in there, effectively
let me actually
reducing your interest rate, if you will, which is a benefit I see.
You're right. And I'm sorry to interrupt you there,
That's
but
right.
You're exactly right. Let me put some numbers on this because it's actually a little better than what you described. I don't want to paint with too rosy a picture. And there's certainly some costs and some considerations.
Right.
Don't just do this because you heard this on a podcast. Do your research.
But yes, we are not. I am not a financial advisor.
And I don't know everybody listening, so I'd have to sit down and chat with you one-on-one too. Yeah. But if you did that with those numbers I mentioned earlier, I just did the math on it. And let's say you repaid that loan over 4 years. Okay. At most of these insurance companies, they charge a simple interest rate, which allows us to have a lower APR. And we can get into why that is if you want, Dave. But let's just, for simplicity's sake, that lowers our annual percentage rate dramatically to about 1.9% is what I see here. And that's a total interest paid of $15,280. That's how much interest you'd pay if you borrowed out, the full amount of money out of that policy the 180 grand. Okay. So roughly speaking, at 1.9, 2.1%, somewhere in that ballpark. Meanwhile, your policy continued to grow on the entire $200,000, even though you'd borrowed against it as if there was no loan. So we're getting that 4, 5%, whatever, 6% on the entire cash value, but we're only paying interest on the remaining loan balance. Okay. So what I'm getting to here is the interest paid would be about 15 grand, but your policy earned over that same 4-year period, $48,600. Now that's really good arbitrage right there.
It is.
That's still a $30,000+ arbitrage, $38,000, give or take. I'll take that over paying cash any day. If I pay cash for something, I have zero.
Yeah, and that's how you effectively make
paying
yourself
cash for those major.
And that's how you can effectively make yourself your own bank, which is obviously why it's called bank on yourself. So I think it's important, like you said, there's a lot of ways it can be done wrong. You need to set it up very, very specifically to do that right. But that exists out there for people that are interested in learning more about that, whether you're a business owner, or maybe you've got some money and you want to look at a place to put it, that you can grow it and then use it to your advantage and not be so beholden to maybe a bank or a financial organization or something like that, and bet on yourself a little bit more. That's a way to do it. And as entrepreneurs, we do like to bet on ourselves, right? Another offshoot from this is I've heard you say that you can make it so that even if someone runs out of money, they don't run out of income. Explain that.
Yeah, that sounds kind of bonkers, upside down, right?
Yeah.
So that's kind of the concern a lot of people have. Hey, Mark, I'm ready to retire. I've been able to nestle away, X dollars in my savings account or 401k or wherever, or even a whole life policy. I'm concerned, Mark, that I just got off the phone with a lady. Her husband's father had lived to 97 years old, and they were concerned that they might make it that long, and they didn't expect their money would last that long. They would outlive their money. And that's one of the biggest fears, a fear worse than death for most of the studies that I read in terms of retirement readiness, is to outlive the money. At least when you're gone, your expenses are over and you're no longer a burden to the family.
Right.
So that is a big concern. Again, insurance contracts have a part to play here. That insurance contract I mentioned earlier from the Roman Empire, it was a pension. It was an annuity contract. Annuities have been around thousands of years. And the whole purpose of an annuity is to create a lifetime income where even if you run out of money, meaning your account value goes to zero, you never run out of that guaranteed paycheck that hits your account every single year, every single month. And that's what sometimes we do, even using the whole life policies. Here's a cool strategy, and I'll keep this brief. Let's say that you've got 5 bank on yourself designed policies, and we structured them right. Again, there's a lot of people out there with, insurance licenses that can design these things poorly. We can go back to that if you want to, but let's say that you've designed them right. Let's say you've got 5 of these whole life policies. And let's say that you're at retirement. Let's say you've got $3 million in all these policies. Awesome. Can you believe it? That's money you can spend as a stream of income. And you decide, because you want to, that you're going to take that 2 of those 5 whole life policies and do something called a 1035 exchange. Now, it's a lot like a 1031 exchange if you're familiar with real estate, but a 1035 exchange is a tax-free rollover from one insurance contract to another. It's the same part of the tax code. So we take a whole life policy and you can convert it into an annuity with that company or a different company that then automatically starts to spin off monthly income that lasts as long as you live. So the cool thing here, this is the story, and I'll hush. We had a guy, he had $1 million line of credit with the bank, $1 million line of credit. The bank terms his loan. They call him up and say, we're exiting your business. Please give us the $1 million. You have 3 years to do it. So he's, of course, pissed, and he thinks his business is going to fail, but he decides to fund a whole life policy. He got it up to $1 million line of credit in his own policy by the time that bank was gone out of his life. And he was saying good riddance. He has since continued to build that line of his cash value. I call it line of credit, but it's really a cash value in the policy. And it's continued to build well past $1 million. And his plan is to take some of that money and convert it to an annuity as a sort of a golden parachute for himself when he leaves the business. He'll take that stream of income that'll last as long as he and his wife, either of them, live. and he couldn't be happier. He's done with banks. He's done with markets. He gets to run his business with a giant liquid contingency fund. What's the downside to all this? A lot of people ask me that about this point.
Mm-hmm.
There's insurance expenses with everything, so don't do this for, get rich quick. This is not about get rich overnight. This is a
Right.
long-term financial tool that's meant to be, dealt with over many years, maybe your whole lifetime. So it's meant to be sort of slow and steady, consistent yield that you can count on.
What are three, you kind of mentioned earlier, they can be set up wrong. What are like three red flags that a policy like this or a setup like this is being done wrong that people should know about?
Yeah, we have a whole podcast series on this because we literally had to count them up. There's over 29 different nuanced dials on our dashboard, you might say, to build these things properly. Just two or three of them. If you have what's called a direct recognition life insurance company, that just means that they recognize that you took that loan and they won't pay you the same dividend. They'll cut your dividend. So in that example we mentioned earlier, if you borrow out 180 grand, you're only going to earn interest on the remaining 20 that you didn't borrow out. That's a deal breaker for me. So that's number one. You want to make sure too that it's whole life insurance and not another type of cash value insurance. There's a lot of kissing cousins out there like variable life and universal life. I don't recommend those tools for this topic, for this strategy. And then third, make sure that you have something called a bank on yourself professional designing this thing. He or she can build the whole thing to spec. You don't have to remember all this stuff. I kind of jokingly say it's a little like your smartphone. I just have to swipe and the thing works. But there's a lot of engineering that went into that thing to build it right.
Great. That's great. Those are things that, I think really succinct people can, look out for if they're going to go down the path with anyone on this. A couple more questions before you get to your Misfit 3. Dave Ramsey has the debt snowball method. You have the debt snowbank method. I think I know where this goes, but explain the difference.
Well, yeah, we actually, and funny enough, we trademarked it, hoping that Dave would get his attention. We haven't heard any cease and desist from him yet, and I hope not. I hope not. But anyway, he's done a lot of good for people, and myself included. I got focused on my budget with Dave, and he's certainly helped millions of people. So kudos to him for that. I think he's dead wrong on whole life insurance. This design of whole life insurance, he's dead wrong on. We can get into that another time. But the debt snowball method that he promotes asks you to list all of your debts one after the other and then knock them out one at a time, keeping about $1,000 in your savings account while you're doing all this. So what could possibly go wrong, Dave? If all you have is $1,000 in your savings account, at least for me and my wife, we would pay off a little debt and then have an emergency, fall back into debt. Pay off a little debt, have an emergency, go fall back into debt. So it was like spinning our wheels. It was very frustrating. Not to mention we had $120,000 of student loan debt. We mentioned at the top of this episode. So, I didn't like this snowball thing. Not to mention we were losing our best dollars. When you're in your 20s like we were, throwing money at a student loan meant not only would we be out that $1 I gave to Sally Mae, but I would be out $9 of what it could have earned for me. Does that make sense? That concept of opportunity cost?
Oh, yeah.
So that was a problem, big problem. And we knew it at the time, but we thought like everyone else did. And that was the problem. We thought like everyone else did. So we stumbled across Bank on Yourself. We started to realize that this could be used as a way to pay off our debts and be better than debt-free. So what we did, here's our 4-step process in the debt snowbank method. Step 1, keep current on all your debts. Don't go behind on your debts. Keep current on paying the minimums. Don't overpay on those unless it really makes sense to. Number 2, throw everything extra that you can that you might have otherwise thrown on your debts, throw into the policy instead. The policy begins to build wealth in the first month, in the first year, and so on. So if you can imagine, there's this big pile of debt, and it's only coming down slowly as you pay your minimums. But you're also flooding your whole life policy or policies with cash value. So that's a pile that's growing. And when they equal each other, step 3, borrow against the policy and wipe out your debts all at once or just one at a time. Doesn't matter. But pay off that student loan debt or that credit card bill. And remember, the policy continues to grow as if you had not borrowed the money out. So step 4, the last step, pay back the policy loan on a payment plan that you choose, that you're in control of. And you can change, by the way, and do this over and over again until you're completely debt-free. In fact, better than debt-free, because you have the asset of the whole life policy earning interest and dividends for you all along the way.
No, that makes total sense. And I think that's a really great example of having your money work for you and do these things, right? You're doing the same thing. You're still doing the debt snowball. You're just putting your money to work and then using the proceeds of that effectively to do that. And I think that's an important thing. And you mentioned like early in your 20s, that's the time where if you can, sock away the most and put it into maybe like a vehicle like this that can continue to grow and allow it to compound. Just the compound, there's a reason Warren Buffett calls compound interest the eighth wonder of the world. Just the compounding alone for 20 years can make a huge difference, right? And so I think that's a really great point. Another thing that I've heard you talk about before is there's somehow a relationship between Mount Everest and retirement somehow. So how does Mount Everest have something to do with retirement?
Well, I'll tell you a different story. Well, first I'll tell you the statistic that shocked me. When looking at statistics of deaths on Mount Everest, I was shocked to find out that according to National Geographic, 85% of deaths are coming down the mountain. Now, I would have thought it was the tougher part was climbing, but it's actually coming back down. And this kind of speaks to my experience when I climbed the famous mountain in Japan, Mount Fuji. Going up was hard. It was like a workout. But then coming down, I literally felt like, okay, I'm about to die here. I might not make it down here. And it was just little old Mount Fuji. I mean, it's a big mountain, but it's nothing like Mount Everest. So, I found a quick story from my background. I was in Jackson Hole, Wyoming, and we were doing some downhill mountain biking. And my buddy and I, we would take what do you call those things? The ski slaloms, or what are those things called? The gondolas, the little ski lift. Yeah, thank you. Yeah, the ski lift. It took the ski lift up. Our bikes were in tow. We're just gliding so peacefully as we go up the mountain. And this is a lot like when you put money into investments in your 401k, your IRA. When you're in your working years, you're just sort of gliding so peacefully as you watch your account balance. The account balance might go up, it might go down. You might see little rocks and pebbles and, a stream and, oh, how pretty, look at that nice pile of rocks over there. But it doesn't hurt you. You're just floating over this mountain as you climb the mountain on your nice, your ski lift. But then at retirement, you get off your ski lift like I did with my bike, and you start to ride down the mountain. And I'm not a skilled mountain biker. I wish I was. My buddy was. I was trying to keep up with him. And I was watching him, much like many of us probably watch CNBC or Market Squawk Box or whatever you want to call it. We're trying to keep up with the pros here, okay? But we're bouncing over the rocks and the rubble and the roots. And in my story, and this happened just a few years ago, I flipped over my handlebars when I hit a big pile or big branch roots that covered the cross of our path. And I went flying over my handlebars and broke my wrist. Now, this is unfortunate because I'd seen this little spot going up the mountain, didn't hurt me, but coming down is where the real danger is. And this is when in retirement, when you're spending money, for groceries, for grandkids, whatever, in your retirement years, you don't have the luxury of floating over all these nice market, downturns. When the market goes down like it did last year, it's like a double pain. You get the market madness and you got you taking money out for groceries. You still have to eat even when the markets are down. So this creates something terrible called the sequence of returns risk. And I'll keep that brief enough for now. That's probably enough, but you get the picture.
Yeah.
Coming down mountain retirement is also the worst time for your investment planner because he or she is getting paid less as you spend that money.
Right.
So how motivated will he be or she be to help you or return calls when you're in trouble?
Yeah.
So again, annuities and life insurance contracts are a great option for smoothing out that downhill. Hopefully should be the ride of your life, right? The retirement plan should be something that gives you excitement, not terror. And so that's what we're pleased and honored to serve our clients in doing.
Well, I think that's a good analogy too. And it kind of to my point earlier, if you lose 30%, you actually have to make almost 100% to get that 30% back, right? So it's, it is tough coming down, especially if you have a big drop that is unexpected, right? My last question for you before we get to your Misfit 3, because I'd be remiss if I didn't ask you a question about, entrepreneurship, just your own journey. So, top lessons that you've learned on your entrepreneur journey that you feel are really important for our listeners and people that are watching to know?
Yeah, well, this is something, I don't know if lesson or just a reflection, but I have so enjoyed the experience of trying to reach for my potential. That's been probably the best unique experience of an entrepreneur's journey is you get to explore where your potential reaches to. When you are somebody else's cog in their machine, you just punch that clock and you do your thing. And maybe you can get really good at pickleball or something outside of work. But what is your true potential as a man or a woman trying to reach for the best way to serve your fellow man? I feel like the entrepreneur could be the saving element to the country, to the world. I don't want to overestimate here, but guys, I can't find a better place to reach for your potential. And potential is such a beautiful thing when it's activated. It's a horrible thing when it's not activated. I always say a rocket ship looks great when it's sitting on the launch pad. But if it is a rusty old rocket that is leaking fuel, it's been there for 30 years, that's a shame. What a waste of potential. I would want anything on my tombstone except he had such potential. Right. So having your potential activated is a very empowering thing. And I feel like that's the beauty of being your own boss and the entrepreneurial journey.
I love it. It's a great way to end it because I can't agree more that, I do think entrepreneurship is the answer to a lot of the world's problems. In fact, really, if you think about it, just about everything starts with entrepreneurship. You don't have tax dollars without an entrepreneurship to a government and so on, right? So, it really does start there. And that's one of the things about this show is that really everybody is an entrepreneur in some way, shape, or form. It's just whether they tap into it or not. And they tap into that misfit side in them that separates them as an entrepreneur. Okay, it's time for Mark's Misfit 3. These are the 3 things that he wants you to take away that you can take, put into your life, your business, make a difference for yourself starting today. And the way that I always frame this to every guest that comes on the show is I say, hey, look, if you're going to leave this earth tomorrow and you can only leave behind your 3 best pieces of wisdom for the generations that come after you to help them live their best life, what would those 3 things be? So, Mark, what are your Misfit 3?
Yeah, I thought a lot about this. And I figured, hey, let's do 3 quotes that really reflect what you asked me there. So how about this? There's a great philosopher, and I'm going to mess up how he pronounces his name. It's Epictetus. He says, it is impossible for a man to learn what he thinks he already knows. And I like that quote. It's impossible for a man to learn what he thinks he already knows. There's another one. Upton Sinclair said, it's impossible to convince someone of something if their salary is dependent on them not being convinced. So remember that. I try to remember that, to be open-minded enough, but not so open-minded that my brains fall out. So that's the first, I guess, lesson or skill to leave behind, let's say. The second is a quote by Elizabeth King. She says, process saves us from the poverty of our intentions. Process saves us from the poverty of our intentions. That's so good. I love that. If I want to cook dinner every night, I'm going to have nights where I want to and nights where I don't want to. But if I have a process that every night at 5:45, I pick up the knife and I open the fridge to get the veggies out, I know I'm going to be on the right track. I've got a process, and it saves me from the poverty of my intentions, right? And then the third is a quote by Aldous Huxley, and this is a big one for me. It says, there's only one corner of the universe you can be certain of improving, and that's your own self. So there's only one corner of the universe you can be certain of improving, and that is your own self. Don't forget that, especially in relationships or your business. Business can throw you curveballs. Life can throw you curveballs. You can decide what those curveballs mean and how you react to them.
Mark, all 3 of those, great principles, great quotes surrounding them. If people do want to learn more about you, where should they go?
Thanks. It's been a pleasure to chat with you today, Dave. We work with folks all over the country, all 50 states. And if you have caught this wind of another way of thinking about money, your economy, and your future, you can date me first by going to our podcast. That's Not Your Average Financial Podcast. get to know us a bit better. If you're ready to chat, we'd have a 15-minute introductory phone strategy session with either me or one of my colleagues. Go to kickstartwithmark.com. That's kickstartwithmark.com.
Perfect. We'll link to that in our show notes so that everybody can find it. The best show notes in the business. No offense, Mark, for reasons that I will talk about more in a second. But first, for those of you that are new to an episode with us, your first time with us, welcome. It is such an honor to have you with us. And I hope you become a regular subscriber or watcher of this show. And for all of you Misfit entrepreneurs that are with us week in and week out, I cannot thank you enough for your support of the show. You are what makes this go in over 100 countries every single week. So thank you, thank you, thank you. And make sure and go out and check out the show notes for this episode. They are the best in the business. Why? Because I do them myself. I actually, as part of my personal growth routine, go back through all these episodes on a weekly basis. And I pull my best pieces of wisdom and advice and tips and things from people like Mark. And then I share those with you. So go check those out. And then give this episode a rating and review, like and comment on it. Help share Mark's message, because we all know, and I said this in every episode, one great episode can change somebody's life. Maybe something that Mark shared today was that missing link you were looking for to get to your next level. So share this with others. And again, Mark, thank you so much for coming on and sharing all your wisdom and insight today.
Dave, my pleasure. Thank you.